What is moving recently? Interest rate seems like it is creeping up again. And this was the October last year high, and it reached a trough just a few weeks ago in January. And now it's moving up again, and it seems like it's breaking the last year high once again. And what we're looking at here is the 10 years yield. Now, what the difference between the yield and interest rate? And basically is this: borrowers take reference from interest rate, whereas lenders take reference from yield. So it means that when yield move up, interest rate will follow shortly. But I think the more important thing is that what will be the impact to the rest of the market, and also does that translate to opportunity to other markets. And before we study into the different tenure, the yield or the interest rate, and how does it impact the different markets, the Fed decision, and where's the opportunity, let's also take some time to read into the disclaimer down here. Let's look at the different yield tenure. There are 2 years, there are 5 years, 10 years, and 30 years. And basically, what is all these? Now, when you borrow money, of course, the bank will give you a different term, whether you want a short-term loan or you want a long-term loan like 30 years. So different tenure will have a different rate. And this is what we're seeing here. And at the moment, the different tenure, there's an inversion right now. Now, what do I mean by inversion is that traditionally, if you're going to lend out or borrow longer term, you will receive a higher interest rate. Say, for example, the 30 years yield, you're going to receive a high interest rate. But what we're seeing here right now in the past few months, there's an inversion. And we could see that the 2 years yield, now at 4.78, it is higher than the 5 years yield at 4.36 here. And it is also higher than the 10 years here at 4.02. And definitely the 2 years yield, it is higher than 30 years right now. And this is why I call there's an inversion. So whenever there's inversion, it means that we got to be really careful about what's going on to the market, especially the inflation and the interest rate that's coming up. And of course, can you hedge or trade into all these yield or interest rate? And the good news is that there's this market called the yield futures by CME, and of course we can look at across the time frame. The volume are relatively healthy, which is I've drawn into trading into the interest rate and as well as hedging using the yield. With this inversion, what is happening to the inflation or the CPI and also the interest rate? And we're going to discuss the mind of the Fed in a short while with this CPI. So we all know that June last year, it was the highest point, and the good news is that inflation is on the descent, and the latest number was at 6.4. But there's this plateauing effect. Yes, it's on the descent, but over the last two data from 6.5 to 6.4, it's kind of flattened here. And what the Fed actually wanted to see here is that they hope that the data, and they are very specific, say that whatever decision they're going to make is very data driven. So of course, if you're going to ask Jerome Powell, if you're a personal friend of his, you're going to ask him where will the CPI will be. Of course, he's hoping that it will come down to 2%, but honestly, he will not know. He's hoping that it will come down, and therefore, what he wanted to see that unless that the inflation is going to move down to 2% in a sustained manner, and that was a very good clue that he has given to the market, at least have given to me on the 14th of December last year. He said that he wanted, his committee and himself wanted to see that the CPI is going to come down to 2% and stay there before he will consider to cut the interest rate. Now, what he's trying to say here is that the market watcher, seeing that the inflation has been coming down and kind of nudge him, say, it is time to cut the interest rate. He said, no, we're not going to do that unless this inflation CPI is going to come down to 2% and stay there and stay before March 2021. And that was the last 30 to 40 years where the inflation was staying at an average about 3%. And that's what he wanted to see. Now, as I survey the ground, about 70% of investors and traders believe that they do not believe that CPI towards the end of this year, this is just a little projection that I have, that is going to come down to about 2% and stay there. Neither most of us do not believe that inflation from 6.4 current is going to creep up and break the all-time high at 9%. Now, most of us believe that inflation likely to stay flat. Now, at the end of the year, it is not up to us to predict whether it's going to close at 5, 6, 7, or 8%. That's not my point of this presentation. Whether it closes at 5, 6, or 8%, it is still well above 2% target. And now, what will happen to the Fed decision? They will continue to hike moderate rate. If from now, the 6.4, the latest number, now I'm not suggesting that the next number will be at 7. I'm just giving you a demonstration that in the range CPI, it means that it's moving nowhere but it's staying firm at maybe about 5, 6, 7, or 8%. If it's set at 7%, say for example, what will happen to the Fed? Every month, they will not try to upset the market by having a massive rate hike of about 75 basis points. They will try to have a measure that they will hike 25 basis points. Likely, then that their hope is to really tame down inflation. And they're not going to upset the stock market. Now, on this projection, if that's true that the inflation or CPI maintain at about being flat, plateauing effect, that's what I call it. And this is my projection for this next 7 meeting, the FOMC meeting that we are going to see. Let's say on this projection of every month, they're going to hike 25 basis points. Now, again, I'm not trying to predict here that I have no idea where it is going to be, but I'm just giving an indication that in the event of a flattish CPI, likely at the end of the year, our rate or the US Fed rate will settle at 6.5%. And how does it translate to the impact to the stock market, and where are the other opportunities that we have? Of course, the stock market will have a lot of challenges, and according to CNBC that I read, most of the listed company will start to feel a lot of pressure when the borrowing rates are at about 5.5 and above. So definitely with an increase in interest rate, a lot of company will feel the stress, will feel the pressure. But of course, I will turn to commodities. I will turn to the interest rate or yield market as well. And let's go back to the yield market again and see what we can do. This is the 10 years yield futures, and you can explore into 2, 5, or even 30 years. They're basically the same. And in the uptrend, the strategy is always, I will always focus to buy on dips. And I'm just going to erase all this line and just going to reconstruct them again. So it will give you an idea how to trade or invest along this uptrend. Now, first of all, if you've been following my past videos, I explained very clearly how to draw an uptrend line. So I'm going to do this again. And first you have to find a point and connect at least 3 dots. Then after that, you're going to make some adjustment. Something like this. Now, so the whole idea is that how to construct a classic or standard uptrend line is that so that you can consider this uptrend line as it is good, that every retracement focus to buy on dips. Now, we saw at least 3 significant trough. 1, 2, 3. At least 3. The rest almost touching there. So I would say that at least 3, if not more, this is a very classic uptrend line. And I'm seeing here is that there seems like there's a double bottom. At that point, just about a few days ago, or about 2 to 3 weeks back, that I'm pretty confident that it's touching here, and we could see that there was a hammer. There's another hammer. In the end, it formed a double bottom. In the context of the macro development, that the inflation is still intact, that I'm so focused that where is a retracement? And we could see here. Let me just draw it again. There's this hammer. There's another hammer and forming the double bottom. But the whole idea is that it's supported by this main uptrend. And I'm believing that in the next few days and the next few weeks to come, this is what I call retracement. It should continue to break, and interest rate or yield should be higher. Now, I'm just going to play with this little widget that the system have. I'm just going to click on the trend and see that if I've missed out anything. and what do they suggest here. And I think it's almost on the dot that the system and my trend line is almost perfect aligned, that we could see the green line, and they are also suggesting that this parallel trend line that I can consider. But anyway, I will just clear this up. And for those that are interested to explore into how I get into the yield futures, so you can learn more about trading the yield futures, just Google CME yield futures. You will find all the necessary information there. So I've included some other of my past tutorials relating to today's discussion at these links below. So keep watching it again and again. You too can get into the market with greater precision. I always enjoy studying the correlation between the markets, and I hope that today's sharing, it will be helpful in how we invest and trade. So really happy that you stayed through this video. You have many great trading weeks ahead.